Hey guys, Tony, good morning here. I wanted to kind of expand a little bit on, how Barclays, sorry, I just finished running, so I'm a little out of breath. But I kind of wanted to expand a little bit on how Barclays actually makes money off of retail traders. If you haven't seen my video that I just released, that Barclays released a thesis on how they make money off of new investors, AKA retail money. It's actually the previous video from this. So, let's get into it, right? The simple strategy that they use is, they tend to sell out of the money calls for at least, a month out minimum, 31 DTE. And the thing here is that a lot of people don't let you know is that if you sell anything under 31 DTE, it actually resets your time on when you bought a certain stock. So you are immediately at risk for short-term capital gains. And that's why you should sell only 31 DTE minimum calls out, especially if you plan on keeping your position a lot longer than a month, right? You're looking for at least a year hold with your gains. That way you don't pay short capital gains. So, if you buy Tesla today and you're holding it for 2 months and then you decide to sell, like weekly calls for September 24th, as soon as you sell these calls, for example, these right here, you'll go into here, you'll sell this call expiring September 24th. Your buy time or your buy date gets immediately reset to September 24th, which is when the calls expire. So what you're doing is you're basically selling your shares to somebody as a contract, and then you're buying them back on September 24th. And that's what a lot of people don't understand, is if you're selling weeklies, 2 weeks, 3 weeks, 4 weeks, you're gonna reset your time on your stock, and you're gonna be liable for short-term capital gains, which is why you should always sell at least 31 DTE from whatever date today is. But let's go into the actual strategy, right? So Barclays, what they tend to do is they tend to sell calls that are, if it's a high ticker like this, they'll go around $200 to $100 out of the money. Right now, Tesla, 758, let's say 760. They'll sell $860 calls, for Tesla, at least a month out. More than likely, they will probably sell a little bit above actual all-time high, so 883, possibly 880. So let's go with like 885 or something, right? Let's see how much that actually nets you. So November 19th, we'll go a month out, which is at least 31 DTE. We'll go with 885. Let's do 890, right? You go in here, for every single 100 shares that a big hedge fund or a company holds of Tesla, you're making $710. But you need to understand that, you're dealing with hundreds of millions of dollars. So if you have, someone in Tesla that owns 100 shares, they essentially have a $70,000 position, in Tesla. But somebody that has 1,000 shares, 700,000 position, then 7 million, and 70 million, and 700 million, right? So let's say we have a $700 million position in Tesla. That would be, you would have how many shares? I should have probably done the math beforehand. So 70 times 100, 70K, 700 million. So like 10,000 shares. This is actually gonna bother me. So let's do this real quick. So you have, 70 million divided by, we'll do 7, what is it, the price? 768, whatever, 780. 91,145 shares. Let's go with 90,000 shares, right? So 90,000 divided by 100. You can basically sell 900 calls for a month out. So a month out, these hedge funds are making almost, over $500,000 by selling out of the money calls. And not just out of the money calls, they're selling higher than than previous highs, right? The previous high was like 880, 885, 880 something, at least on the close. And now they're basically netting, you know, an easy over $500,000 monthly, you know, which comes out to like what, $6 million every single year. And this is on one position. This is only on one position, and they essentially can roll this over infinitely, right? Obviously they can go, you know, lower into be a little bit like a riskier play. So if they only did $100 out of the money, actually we were just there, so they can do, like, you know, like I said, 860. Let's say they do 800. Well, not 800, that seems too risky for even the hedge fund. I think we'll stick to 860. But, you know, essentially, you know, they are, you know, they're making, whoops, is 860? Oh, so even then, you know, 1 month out, you know, they're selling 900 calls to whoever is willing to buy them, and it's, you know, $100 out of the money, and they're making $1 million every single month. But again, this is how they're making money, essentially selling out of the money calls in mass volume to retail traders like you and me. So, you know, while it does say, let's say, you know, for them, let's, you know, 860 chance of profit is 86%, right? You guys can see it right there. If you sell an 860 call, you have an 86% chance of netting in, you know, this easy $1 million in a month, which would obviously equate to like 12 mil every single year. And again, this is on one position that's worth 70 million. If you're netting, you know, $1 million every month, that just means you made on that $70 million position, you just made $12 million for the year by simply selling out of the money calls that are more than likely going to hit. That's what, a little bit, that's higher than 10% return by just sitting on it, which is absolutely insane. And that's not only sitting on it, but that's also, you know, Tesla gradually increasing. And keep in mind, Tesla right now is not exactly in the high, so premium is also kind of low. These can definitely be higher, at least the premiums for this. But again, this is just a simplification of what Barclays, the method that they're using to make money off of retail. And it's because there's such a huge influx of new traders coming in, where there's just a bunch of money to go around for out of the money calls. You know, I would not be like, these would not be going for sale, you know, if they didn't actually hit, if you know, big money market makers, you know, they wouldn't sell these unless they would be able to know that there's a really high chance that they're gonna make money off of this. Like, you have retail buying this, right? A $1,400 call for Tesla for a month out, you know, and you gotta, this is what, almost a full 100% gain in Tesla, which would be like a full $1 trillion addition into their market cap, almost $1 trillion, maybe $500 billion. I forgot what their market cap is. But keep in mind, you know, market makers will not be selling these out of the money calls if they not think that this would be easy money. So, you know, just keep that in mind whenever you buy calls that are out of the money. Chances are, on the other side, you have a really big hedge fund or a really big market maker, basically, you know, betting that, you know, that you're gonna lose all your money. So, you know, just be careful when you're trading options, because hedge funds are a lot smarter than you think. Banks are a lot smarter than you think. Obviously, there's a lot of stuff going on right now, but, you know, don't knock a system that's been taking away retail money since the beginning of capitalism. I'll see you guys later. Bye-bye.